We've discussed the importance of identifying the trend of the market to improve your trading, but many investors get stumped on how to get in on a trend that's already underway. Well, that's where pullbacks come into play. Pullbacks, also known as counter trends or retracements, are short-term moves in the opposite direction of the overall trend. They provide traders an opportunity to join an ongoing trend at a relatively favorable price. Pullbacks aren't only useful for entries in the market, but also re-entries, otherwise known as POPs. POPs simply stands for profit off pullbacks. When you pop, essentially you are getting multiple entries to ride the same trend. Let's take a look at how you can identify pullbacks within the market and utilize POPs to maximize your profits. All right, you guys, so let's go ahead and hop straight into this training for POPs. So as stated before, POP stands for profit off of pullbacks, all right? So as you guys can see right here on the screen, I have drawn my own visual representation of what a chart looks like, right? We have the black lines representing our XY axes, and then we have these purple rectangles dead smack in the middle of the chart, representing our zones, our support and resistance areas in the market. So for this example, we're actually going to be entering a trade for a buy on EURJPY, and we're actually going to be leveraging a 0.05. Now, we should all be aware that a 0.05 represents 50 cents per pip in the market. Now, we also know that the market does not move straight up or straight down, right? The market actually moves in waves. It breathes. So let me show you guys what I mean. It moves up, then it moves down, then it moves up, then it moves down, right? And it continues in this pattern until a new trend is created. So typically when we look for an entry on a trade, where is the most optimal place to get in? At a level of support or resistance, right? So in this case, what we want to do, since we're in an uptrend, is we're going to wait for price to actually break through this level of resistance right here. All right, we're going to want it to break through this level of resistance. So when price finally breaks this level like this, what we're going to do is wait for a retest to the same structure, and we want to go ahead and enter if price respects this zone. So if price respects this structure, we're going to go ahead and enter the trade right here at this blue dot, right? And we're going to enter in with a 0.05. Now, once price respects this structure, it's going to go ahead and continue in the upward direction, right? But the thing is, as stated before, the market does not move straight up. So even after we enter our first position on this trade, the market has no choice but to pull back. All right, so let's say the market decides to pull back about halfway through this zone. Let me go ahead and mark up the halfway zone. I'll do that in purple. So this is about halfway through the zone. Now, at this point of pullback in the market, you guys, this is where we can actually get into the trade again. And we would actually get in with another 0.05. And again, the reason we're getting in, you guys, is because the market is pulling back, which is actually giving us another opportunity to get into this trade at a favorable position. So once we have entered this second entry on the trade, you know, we can then expect the market to go up to our TP or our next level of resistance. Now, I want to actually show you guys how this benefited us, all right? But the only way we're going to truly understand how this allowed us to maximize our profits is if we do a little bit of math. So let's say that between this zone and this zone, there's a distance of about 20 pips. So that means about halfway through the zone, that would make the distance from here to here about 10 pips. So on both entries, we got in with a 0.05. As stated before, that represents 50 cents per pip. So if we're going to do the math, 50 cents will be represented by 0.50. Now, we did get a distance of about 20 pips, right? 20 pips on our first entry. So we're going to go ahead and multiply that by 20 to figure out how much money we would make on that first entry. So 0.50 times 20 is actually equal to $10. So just on this first entry right here, you guys, we were able to make $10. But we can't forget that we got a second entry about midway through these two zones. So again, I'm going to do the 0.50 representing 50 cents, right? Because we did leverage 50 cents, 0.05 on our second entry as well. But instead of going for 20 pips on the second entry, we only got 10 pips. So we're going to multiply 0.50 times 10, and that is actually equal to $5, you guys. So imagine if we would have just gotten into this trade with that one entry. All right, we would have only made $10 on this trade. But the fact that we were able to capitalize on a pullback actually allowed us to maximize our profits and gain an additional $5 on our second entry, right? We got entry number 1 here and we got entry number 2 there. So in total, you were able to make $15 instead of just 10. All right, so I hope you guys are following me, but if not, don't worry. I'm going to do one more example for you guys. So in this example, we're going to still be working with EUR JPY, but this time we're going to be doing a sell, and we're going to be leveraging a 0.10. Again, please remember that a 0.10 actually represents $1 per pip in the market. So for our sell example, again, we have the market moving in waves, right? Pushing down and then pulling back up and then pushing down and then pulling back up. Now for a sell, we want to see price go ahead and break this level of support. So price goes ahead and pushes down and breaks this support. And what we do is we wait for price to come back up and retest this level of support. Now, if price respects this level of support and cannot break back through it, we know that this is the perfect time for us to get our first entry on this trade right here at this blue dot. All right, so we would get in with a 0.10. So after our first entry, price continues to push down and it ends up pulling back about midway through these two zones yet again. So let me go ahead and mark this halfway point. Now, when price pulls up, we want to wait for some kind of confirmation, you know, an engulfing candle, a flat top candle, just depending on whatever candle you're looking for, some kind of price action that confirms to us that this market is going to continue down. And this would actually be our second point of entry. So we would get in again here at 0.10. And after our second entry, the market actually continues down to our take profit zone. So this time between these two zones, you guys, there was actually a distance of about 30 pips. So that means that about halfway between these two zones was a distance of 15 pips. We leveraged a 0.10 representing $1 per pip. So on our first entry, I'm going to multiply $1 times 30, right, for these 30 pips. So 1 times 30 is equal to $30. So if we would have just entered this trade once at this first point of entry, we would have only made a total of $30 on this trade setup. However, since we were able to take advantage of the pullback within the market, we gained an additional 15 pips. So let's do $1 times 15 for these 15 pips right here. So 1 times 15 is equal to $15. So yes, you guys, we were able to make an additional $15 for a total of $45 on this one trade setup. All because we decided to get that second entry. So before I end this lesson, I want to do a couple more examples of how to identify a pullback in the market. So you guys, the easiest way to identify pullbacks is by drawing trend lines. So as you guys can see, this blue line right here actually represents our trend line. And this just so happens to be an example of an uptrend. Now, hopefully you guys remember that the characteristics of an uptrend are higher highs and higher lows, right? We got our low, we got our high, we got our higher low, we got our higher high, we have our higher low, our higher high, higher low, higher high, higher low, higher high, and our final higher low. Now, in the case of uptrends, the best point in the market to pop would be at these points of higher lows. Whenever the market pulls back to the trend line, respects it, and ends up creating a higher low in the market, these are the best times, you guys, to actually get another entry on your trade. As long as price continues to respect your trend line and refuses to break through, you can expect the market to continue going up. So that is why it is important to get in at the lower points in the market. You want to make sure that you are buying low and selling high. All right, so let's move on to one final example of a downtrend. We have this blue line representing our trend line. And again, we should remember that the main characteristics of a downtrend are lower highs and lower lows. So we have our high, we have our low, we have our lower high, we have our lower low, we have our lower high, our lower low, lower high, lower low, lower high, lower low. Now, in the case of a downtrend, you guys, the best point of entry for a pop would be at these lower highs, right? As long as we can get price to come up and respect our trend line, right? Meaning it cannot break through, it tries its best, but it does not gain enough momentum to break through this trend line, we can expect the market to continue down. So if that is the case, we want to make sure that we are getting in at the highest points in the market. Because what did I just say? You want to buy low and sell high. So hopefully these visual representations really helped you guys, but that is about all for this training. That concludes this lesson. If you have any questions or remarks, please join my discussion board and make them known. Feel free to follow me on social media and leave this emoji under a recent post for a follow back. Thanks again for tuning in to Money with Mari, and I'll see you on the next episode of Forex 101.